And so when you see Bitcoin chopping around, going down a little bit, guys, again, it's telling us something. Think of Bitcoin's price. Don't be mad at it. Don't get emotional about it. Think of it like a truth machine. It's speaking to you. When Bitcoin's going down, what it was telling us is there's not enough liquidity in the financial system. Bitcoin is a truth machine. It's telling you the realities of the world around you. Things like the US government, things like the stock market, things like the Federal Reserve. These things are distorting reality. They're manufacturing volatility to be down. They're engineering risk out of your life. They're not telling you the truth. They're not telling you what's real. Bitcoin is. It's in fact, I'd make the argument Bitcoin's the only free market we have left in the world. It's in the financial system. It's in the pipes, and the pipes are breaking. Seeing Bitcoin bounce around, seeing it react, seeing it move 5% up over the weekend as the US government seems to be coming back, and as Trump is introducing stimmies. Brrr. You hear that? Shh, shh, shh. You hear that? That's the money printer.
As crypto holders prepare for a massive December, and major companies like Michael Saylor's firm MicroStrategy continue buying, investors are growing increasingly bullish heading into the final month of 2025. However, Jack Mallers has issued a warning to all Bitcoin and crypto holders, saying the recent sell-off is only the beginning. According to Mallers, a coming Bitcoin tsunami will change the crypto landscape forever, and discusses what he sees as the inevitable collapse of the fiat monetary system. He says there's a coordinated plan to take over Bitcoin and the broader crypto market. With BlackRock among the largest players entering the space, Mallers suggests that this might soon be the least of our concerns, as entire nations are now pursuing Bitcoin. Bitcoin's current price is sitting just under $97,000, still down over 14% in the past month. Mallers argues that it's more crucial than ever for nation-states to adopt Bitcoin and integrate it into the global economy before the existing financial system collapses. In this latest interview, he shares his predictions for Bitcoin's trajectory in the coming months, and explains why he believes a massive surge of capital is about to flow into the crypto space. Drop your comments down below and subscribe if you enjoy the content we do here.
It's really interesting to see Bitcoin move. So first and foremost, let's talk about fiscal dominance, when deficits set the monetary policy. For those that don't know, fiscal dominance is when, first of all, there's the US government, which is financed by the US Treasury. So, we've talked about Scott Bessent, our boy Scotty B. Scotty B is effectively the CFO of the US government. He's in charge of financing what the US government needs. The US government needs military, US government needs health and human services, it needs to pay interest on its debt, it has expenses. And it's Scotty B's job to make sure that those expenses are met. And they're met either with income and revenue, like tax receipts, or they're met through financing new debt and selling things like T-bills, okay? Then you have the Federal Reserve. The Federal Reserve is supposed to be an independent central bank. The Federal Reserve is not supposed to be a part of the US government. The Federal Reserve is supposed to be independent central bank, not political, okay? Now, whether that's real or not, we all know that the Federal Reserve is highly political and they exist to perpetuate the regime that is the Pax Americana, the empire. But that aside, they're supposed to be two independent things. Now, the concept of fiscal dominance is when the needs of the US government and the needs of the Treasury and the needs of Scotty B to perpetuate all Trump's plans and all politicians' needs to get reelected, when those needs and desires outweigh and crowd out the quote-unquote independence of the Federal Reserve. So when I say when deficits set monetary policy, deficits is our government deficits, all the debt that we have created in the past and continue to create to march forward, it is setting monetary policy. It's demanding new money printing. It's drying up liquidity. And that is a very dangerous place for a government and a currency to be in. This is emerging market behavior. Okay, this is like Argentina. Okay, this is behavior where the government is so indebted, the only way out is to print a bunch of money. And that's what I mean by fiscal dominance. I've been throwing these terms around, SOFR, IORB, there's all sorts of stuff. I had a thesis last week on the show that maybe the US government is purposefully shut down to dry up cash reserves in the financial system to force the Fed to do what the government needs them to do. That this would be an egregious manipulative form of fiscal dominance. So first and foremost, this is from the Federal Reserve Bank of New York website. And this is literally from their website, secured overnight financing rate. So when I say SOFR, that's it, SOFR, secured overnight financing rate. The secured overnight financing rate, SOFR, is a broad measure of the cost of borrowing cash overnight collateralized by Treasury securities. Okay, boom, simple. I'm not even gonna read the rest. So it's the cost of borrowing cash, money, collateralized by, call it, US Treasuries, okay? Next, from the Fed's website again, what is IO, interest on reserves? The Federal Reserve pays interest on reserve balances. That is that IORB that I keep referencing. The Board of Governors has prescribed rules governing the payment of interest by Federal Reserve banks in Regulation D. So it's very simple. IORB is the interest you get for parking your cash at the Fed, okay? SOFR is the cost of borrowing cash collateralized by treasuries, okay? Now, what's been happening recently that has all these economists up in arms and panicking is that SOFR, the rate for SOFR, so the rate to borrow cash collateralized by US Treasury securities, has exceeded the interest on cash, okay? That is a big deal because traditionally it's not supposed to work that way. It's intended to be the opposite. You do not want the cash reserves being lent out. The system is designed so that the interest on cash parked at the Fed pays you more than the secured overnight financing rate. Recently, this rate has done the opposite. You can see here, it's typically, I don't want to say there's a target because there's not actually a real target, but generally in a healthy market, it's about 10 basis points below. So you can see here, this 0.1. This is a healthy market. We're seeing January, well, relative. January 2022 through 2023, and then you can see some unhealthiness at the end of last year, and it started to get a little volatile. It started to spike a bit, and now it's really gone vertical very, very recently. This imbalance happened in 2019. Now, not the exact same, not SOFR over the interest on cash, but the same practice is that cash reserves got very, very scarce. The Fed implemented something called their standing repo facility to basically fix this problem going forward.
The ongoing adoption of Bitcoin by governments, institutions, and media signifies a broader recognition of its value. However, Mallers asserts this journey is just beginning, comparing the initial years to the current widespread interest and investment, with a giant spotlight on Bitcoin ETFs. Mallers highlights this being a significant development in the financial ecosystem. He also suggests that BlackRock, under the guidance of Larry Fink, leads the charge in obtaining regulatory approval for Bitcoin ETFs. Moves like this, he contends, will underscore Bitcoin's enduring relevance as an asset and its potential as a hedge against currency devaluation.
So this is again from the Federal Reserve Bank of New York's website. What are the standing repo facility's operations? At its July 2021 meeting, the Federal Open Market Committee, FOMC, established the SRF, the Standing Repo Facility, to serve as a backstop in money markets to support the effective implementation and transmission of monetary policy and smooth market functioning. That's a very fancy, professional, Harvard-educated way to say we stood up this facility where if there are no reserves, if people need printed dollars to get financing in these markets, they can come get it. We will give it to them. So the standing repo facility was created after the 2019 drama and crisis that we saw in funding markets. And it is effectively a facility created by the Fed to give freshly printed dollars to protect the rate of these funding markets. Does that make sense? When the interest on reserve balances is over the SOFR rate, that means there's plenty of liquidity in the financial system, okay? There's plenty of cash to go around. When this happens, when the secured overnight financing rate gets higher than the interest on cash, that means there's more US Treasuries flooding the market that need financing than there is cash to finance them. That's the easiest way to think about it. When the market's operating normally, there's plenty of reserves, there's plenty of cash in the system. When it's not, when you see spikes like this, that means there's not enough cash to finance the amount of US debt that's being issued into the market. So now we keep going, and if you guys have questions on this, I'm happy to answer in the Q&A. So now we keep going. If we look at this repo facility that the Federal Reserve stood up, okay? So again, this was a facility to protect against these funding crises. When the market gets super illiquid, there's not enough cash reserves to finance the government. Guys, what's a U.S. Treasury? A U.S. Treasury is you're lending to the U.S. government. Scotty B is issuing these things and raising money to continue to fund the U.S. government because the U.S. government runs about a $2 trillion annualized deficit a year. As the world reserve currency issuer, it's implied you have to run these massive deficits. So when we look at how active the standing repo facility has been, this will tell us how much newly printed money these market participants needed to continue to fund the government. If you look on Halloween night, it was tapped for $50 billion. And you can see relative to other nights and other days, now, hopefully and traditionally, it's never tapped at all. You don't need newly printed money to sustain and finance new T-bill issuance, new U.S. debt. But the reason everyone was up in arms about this, including myself, is because you can start to see the system falling apart. You can start to see there's scarcity in reserves within the financial system. There's not enough cash. And the thing that people don't actually understand is that it's T-bills, it's the U.S. government that is issuing these short duration debt instruments. That's the reason there's not enough cash. If the U.S. government finances itself with 10-year treasuries, so they're borrowing money, they don't need to refinance or owe it back for 10 years, for 30 years. That's a lot easier on Scott Bessent and the U.S. Treasury. They don't have to constantly be raising money, refinancing it, rolling it over. When they're raising T-bills, so all of the U.S. government debt issuance since like halfway through Biden's term with Janet Yellen and now in the first year of Trump's term with Scott Bessent, they keep going to the front end of the curve. What that means is they're not doing 30 years or 10 years or even 2 years. They're doing like 1 to 3 months. Like what Tether buys? Tether is buying T-bills. So yes, they are buying U.S. debt. They're buying very short duration. That puts a lot of pressure on the U.S. government, particularly Scott Bessent, to be able to finance all of this. And so you're flooding the market with new T-bill issuance. When you have so much T-bill issuance flooding and hitting the market, it pulls all the cash out of the system, right? So think about it. All of our bank deposits, money market funds, endowments, these are the predominant lenders to the U.S. government. They're buying these instruments. If Scott Bessent, instead of issuing like one load of 10 years and not having to worry about it for a while, he's constantly issuing these T-bills, these shorter instruments. When you ramp up that way, you need a lot more cash liquidity to finance the U.S. government.
Jack Mallers challenges the conventional economic metrics, asserting that these metrics are often manipulated to paint a specific narrative, like labor statistics and inflation figures. The ongoing adoption of Bitcoin by governments, institutions, and media signifies a broader recognition of its value. However, Mallers asserts this journey is just beginning, comparing the initial years to the current widespread interest and investment, with a giant spotlight on Bitcoin ETFs. Mallers highlights this being a significant development in the financial ecosystem, selectively measured to create desired effects rather than reflecting the true state of the economy. In this context, Bitcoin emerges as an alternative, detached from the manipulations of the conventional economic sphere. Mallers also highlights that established corporations like Apple, Amazon, and Google will use their established relationships acquired over decades to swiftly acquire substantial amounts of Bitcoin through a spot ETF, bypassing the cumbersome processes involved in procuring the actual commodity. This disparity underscores the transformative power of cryptocurrencies in traditional financial institutions. Michael Saylor underscores the importance of embracing digital currencies as the economic landscape is changing rapidly and urges investors to leverage Bitcoin's potential to secure a more prosperous financial future. What do you think about the latest interview with Jack Mallers? And how do you think Bitcoin's trajectory in the coming months will impact the crypto market and the world of investing.